Investing Insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
G'day, how you going? Phil Tarrant, Property Investing Insights. Catching up the back end of April, trying to work out what's going on with the world at the moment. No one really knows. I picked up the paper today, the Daily Telegraph, and had this big headline telling us that changes to the CGT will have nothing to do with housing ability or the price of housing or affordability of housing. So this debate is going to be a hot one as we run up to the May budget. We'll talk a little bit about that today, plus how to navigate this market, particularly if you're a buyer, and smart buyers buy in times when other buyers aren't buying. So it's going to be a theme of today. Joining me in the studio, Victor and Reshmi Kumar over at Right Property Group. Gang, how you going? Good to see you.
Good.
Welcome back.
Thank you.
This is
Another month.
This mood lighting is very nice. It's very intimate. Very another month.
Yeah.
Another episode.
That's it. And you can see there's a halo on top of my head.
It is. How many of these have we done now? I reckon
I've lost count.
We're past 100.
Yeah. I mean, when you get traumatized, you just lose count.
Yeah.
Oh my gosh.
I don't think we actually ever celebrated 100th episode.
No, we haven't. We've gone to what? I think it's closer to the 200 mark
Close
now.
to 200, if I remember. Yeah. Once.
Now we've started doing podcasts away from you as well, where we share our client stories.
They're the ones that do better than these, right?
Yeah, of course.
A lot more engaging and
That's
connected.
it, yeah. I actually introduce it as this is the one without Phil and the one with substance.
Yeah.
Oh my gosh, yes. No, that's a good one actually. A lot of clients' stories are shared there, so people get to learn.
That's cool.
Yeah.
Yeah, it's good. And you're right on track. That took place last week.
Yes, it did.
It's back live.
It's back
by
live.
popular demand.
Yeah. Reshmi twisted my arm and said, "No, you got to do it."
Yeah.
And so it was pretty good to see clients that we've been dealing with virtually. So we've been talking on Google Meets and Zoom to physically press the flesh, as they say, and also them bringing in other friends to show them what they're doing.
So you're allowed to bring a friend, are you?
You're allowed to bring a friend, you're plus ones, or two or threes. And the night was all about really getting away from instant gratification in terms of property and looking at it from, okay, historically, where is it heading? What has it done? What were the trends? And how can we use that to actually create a investing methodology that is away from all the noise?
So how many did you have out there?
Around 70, which was the cap, 60 or 70, I think
so
it was.
Where was it?
So this was at RSL Club in Parramatta, New South Wales.
Oh, really?
Yeah.
Para, RSL Club.
Yeah.
Yep, that's it.
So we were not at Ridges this time. Yeah, there's parking's the issue over there. This was a better venue. We thought.
Yeah, okay.
We
So
thought
that's
it
where
was
you're going to
really
do it
good.
before. You're going to move it around a bit.
Potentially.
Yeah, okay.
If there's any event organisers listening out there, discount 50%, I'll come to your place.
And I remember going out to these probably a decade ago when it was at Ridges in Para. I remember we always used to sit there afterwards and have a beer and a debrief for our good friend Steve Waters downstairs. And
Well, I had a
work it
couple
out.
of people ask for you.
Really?
Is Phil not here today?
Oh, well. Hey, if I get invited, I'll come out and, if you want me to say anything, I can. I don't know what I'm going to say. But I remember them being, this is like probably before the days of podcasting.
Yeah,
podcasting,
absolutely.
Maybe we just only really kicked it off. And it was a different world.
It was
a
totally
different world. So are investors coming along to these sort of, face-to-face information, evenings, are they different than what they were a decade ago?
Very different in the sense that they are a lot more informed, and what they're trying to do then is weed out all of the, can I say BS of the worlds.
There's no BS in property investing.
No, not at all. Yeah, yeah. To weed out all that. To
What
see,
is
okay,
it?
what's the
BS
reality?
is in buyer sentiment.
Yeah, bias sentiment. Plenty of bias sentiment.
Yes. Yeah, but no, definitely the crowd has changed. But the want has not changed. Everyone wants to be successful at this, right? It's just trying to find out what's the best way forward for them. That really gets them out seeking the information that's relevant.
Yeah. Older, younger?
Mixture.
Yeah.
Mixture.
Yeah, compared to before. What about sort of ethnicity?
Oh, still a mixture as well.
Just a mixture,
Yeah. So we had a very diverse group in there, not just full of migrants. It was true blue Aussies as well.
Yeah, true blue
and
Aussies.
like me. And there was also a very diverse range of age groups in there as well, right? There were few grandmothers in there as well.
Oh, really?
Looking to invest for their grandkids and looking to invest or help their kids invest as well.
Yeah.
So, yeah.
Property investment is a great leveler, and people say, no, it's completely opposite. It's only available for the wealthy, right? But, when you look at property investment, irrespective of ethnicity, where you come from, how you arrived in Australia, it's a great leveler and it's a great enabler, I think, for migrants in particular. Migrants, I just see they're just hungry.
Aren't we a country of migrants anyway?
We are a country of migrants, and it's good to see that sort of, that's something which allows them and empowers them.
I think if where people come from, if their backgrounds were of not really as grand and looking for opportunities, they didn't have a great life. They're coming to build a life and make the most of their, life here in Australia. So, going back what we did, that's all we know is property investing, because that's all we did. We just really wanted to make the best of our time here. So that's how most people think, I think.
Yeah, you got to start somewhere. And where were most of your sort of attendees on their journey? Just some of the start, some in the middle, some of the end?
Some were just looking to get in, and so they were exploring. Others were at the tail end of their investing as well. So quite a few in the middle stages of investing.
Yeah. And what were the sort of main theme? Were people sort of sitting there a bit slumped and sort of concerned about what the future holds with all the noise in the market right now? Or was there by investing in this type of stuff, it shows that they're putting a step forward, so they're probably more on the positive mindset side of the ledger rather than the negative mindset. But what was the sort of the morale of the room?
Look, the morale was very buoyant, right? The question that needed to be answered was, what do they need to buy?
Yeah.
Not where and not how. It's
what.
Yeah.
Okay.
And I reckon, and I've said this before as well, right? People ask the wrong questions when they're investing. The first question they ask is, where do I need to invest? It really should be, once you've honed down your financial capability, your goals, the next question is, what do I buy? Yep. And that keeps you safe from what's happening out there in terms of the noise, in terms of the social media spooks and whatnot. Because it keeps it in line with your financial capability and what you're trying to achieve, as opposed to trying to catch onto a fad or trying to follow the herd into a particular state or a particular area, particular property type. It just keeps you safe.
We've spoken about this on our special Design Your Decade series, but what are the variations of inverted commas what? When you say what to buy rather than where or when, what are the different whats?
So there are a couple of whats in there, right? Yeah. So the what could be something that, gets you out of jail in the sense that if things go wrong, you're able to offload that property really quickly, regardless of where the market is, and walk away with money. So this is something that's equity rich. You're making it equity rich. The other could be it's just a growth property where the subsets of growth, quite a few details, and go back to our previous podcasts. Then we've got your cash flow properties that underpin. So whether it is a small development, whether it's a commercial property, whether it is a property that you're creating that extra cash flow from, and then you crown that off with obviously the generational property, which is probably the last one that you sneak into the portfolio.
The quick pay down as well.
Yes, that's right. And the quick pay downs, right? This is where the units and all that come into play. And then offline we were talking about the one bedders and all that were being snapped up by savvy investors with good yields. They can be. Your exposure isn't that high in terms of the mortgage. You're able to pay them off within a 5, 7, 10-year cycle. And it brings in, 30, 40, 50K of income gross.
To help you pay down the other properties.
So do you speak at the...
No, I didn't. No.
Here's a fun story.
Show, was it?
No, it was a Victor show, yes.
Here's a fun story. I introduced all the staff and I overlooked Reshmi because she was handling the online broadcast, right? And then I had to stop and make sure that I wasn't going to get the couch for the night and introduce her.
What is your official role at
just show my pretty face. That's it.
Is that it?
No, I do. I'm providing this sense of stability and making sure, just to make sure that when people are investing, it's not about all the stuff that goes on with the actual transaction, actual property. There's a lot more of let's say the coaching approach, the mindset side of things.
Yeah.
So that's what I do.
You're probably busy at the moment then with the mindset side of things because there's a lot of noise in the market right now, and the noise for a lot of people is sort of overpowering or deriving the narrative that they're sort of embarking on the property investment journey. So you're getting a lot of phone calls. What do I do?
What happens is with this uncertainty, I think what people are looking for is stability. And where do you get that stability? It's just knowing that you're on the right path and not forgetting your own goals and sticking to it, knowing that what you've chosen to do is right. So yes, we're having people wanting to know what to invest in, but at the same time, are they sure of what they're going to be investing is going to get them to their results? Yeah. So our role here is to kind of guide them not only with the property, but show them that the strategy and the results and experiences that we've had is going to get them to that. So providing that stability in this uncertain time is very, very important. And so that's what we try and do. And how do people find that stability in these uncertain times? Pretty much is a matter of knowing who is guiding you and the experiences and the success of the person or people guiding you or behind you. That is what tells you that, okay, I'm on the right path. So that's sort of where
it's at. Yeah. It's really interesting moment in time, Victor, and if you view this market through one lens, you would think, yes, there's a lot of uncertainty. Yes, the most uncertainty it's been in a long time. So many forces which are working against property at the moment. It's the right time to do nothing. Like that's one lens you can view it through. Yep. And then the other lens is to say, well, the Australian property market is as stable as it's ever been. Yes, there's always some noise at the fringes, but inherently the Australian property market is ... Look back through history and you'll see how it performs through inverted commas crisis. So, everyone is operating in this bubble of inverted commas uncertainty. And even the Treasurer we saw, he was in Washington, recently sort of saying while he was out there, their decision-making is essentially being the government's decision-making around, the budget and tax reform and all these things is being held hostage by decision-making by Washington, Tehran, and Tel Aviv, right? So they're saying even the Australian government can't make its decisions because they don't know what's going to happen, and therefore everything is we're waiting for it. It's paralysed. And we spoke about last time we got together that the budget that we're moving ahead into over the next couple of weeks in May is significantly tempered probably from the budget that would have been delivered should the events in the Middle East not have taken place. The budget that was being formulated in the summer is probably very different to the budget that is going to be handed down by the Treasurer in May. But they've been very, very clear that there is going to be some seismic changes to the way in which property is treated from a tax point of view and how the government's going to be approaching productivity and resilience and all this sort of stuff. So the Australian government is also operating in the same sort of, bubble or even a vacuum of uncertainty. They don't know what's going on.
That's right.
So what do you do about it? This is where mindset really is key.
It is very much so. And the first thing we need to understand is that there's always going to be a crisis. There's always going to be a catalyst. There's always going to be a hurdle when you're investing.
The volatility is always going to be constant.
That's right. Yeah. That's the only constant in property investing. There you go. I coined something. So if you look at, and one of the things that I did in the presentation on Right on Track a week or so ago was I tracked what happened to property from 1980 to 2026.
Okay.
Yeah. And we looked at the key markets, so Sydney, Melbourne, Brisbane, Perth, Adelaide. Yeah. And now in that, since 1980 to 2026, there's several things that happen, right? So if you look at the highest rate of interest rate increase was in 1987.
Yes.
The highest interest rate was in 1990. Yep. So
the highest rate of increase
was in 87.
So went from X to Y.
Yeah. Yep.
Yeah.
And then, but the high when it reached its peak was 1990, and that's when we talked about the 17% interest rates.
That was 1990.
Yeah, that was 1990. Yeah. And then we've got other stuff that happened along the way. So the GFC, we've had the finance, the APRA crunch, all of those things. Then we had COVID, all of those, right?
Yeah.
So the interest rates were going up and down all over the place, right? So whereas when you tracked the property values, the median price values of each of these states, sorry, when I say state, I'm meaning the cities, right? Because that's what you normally measure. So when you looked at those, the trajectory was always upwards. Yep. And because we dampened it to a year spaces rather than monthly spaces, there was no big drops, there was no big rises. It was a consistent rise. The only abnormality, of course, was during COVID, where interest rates were 2%. So there were sharp rises across the board.
Yeah.
But the general trend of property in Australia, regardless of what crises we've had in the economy or in policy changes, has been upwards. So if you look at that and understand that property investing is a medium to long-term play, it's not an overnight success situation.
Yeah.
It will traject upwards, right? So if you're investing today, or you're waiting until the May budget, or you're waiting until the Middle Eastern war finalizes, you're going to get pretty much the same result, albeit maybe a little bit less of a result, because there's a couple of things working against you right now. The first is that inflation is eroding our ability to borrow money, but inflation is increasing the price of property. Yeah. Then we've got obviously with the interest rate rises, and the jury is all aligned in here to say that we will have several interest rate rises. Your borrowing capacity still drops. Yet the number of properties, it may be that there's more properties on the market, but it'll still be higher price because you've got a few other things working against us now. The cost of building is consistently going up. We're not building enough homes. And when times are tough, everyone floods to the safe haven of properties. Yeah. So you will be still buying at the same price, if not slightly more, slightly less, but the quality of your properties would be different going forward, right? So you're better off getting into the market right now as safely as possible. Now, how is it safe? You don't speculate. You work on the worst case scenario of cash flow. So if I look back at the graph during the GFC, there was value drops, right? So the maximum value drop was around the 8 to 15%, depending on which data sets you look at. And the value drop did not cause people to lose property. The value drop caused people to change in terms of their mindset. But what really lost them the property was the cash flow, inability to hold on to the properties. Then we overlay that with what NAB's done yesterday, day before, where apparently they've set aside $700 million to cater for delinquent loans because they believe that we're going to go in for some tough times going forward. And I then overlay that with what's happening on the ground. I'm starting to see a few mortgage in possessions in the mortgage belt areas. So when you look at all of that, it's a perfect storm. But you can either get a property now, or you can wait for 6 months, 12 months and get a property that's perhaps a lesser value, even though the market may go down. So the idea of investing is that you ignore the big troughs or spikes because you're taking a 5 to 10 year approach towards investing.
Yeah, you're smoothing it. You're smoothing it. Of that graph from 1980 to 2026, which showcased the fluctuation, the official cash rate, and property prices, did you have a mechanism to actually map the influence of inflation on growth? To your earlier point, you know, one of the reasons why, irrespective of, there is a correlation.
Yes,
there is a relationship between interest rates and property price growth, but they also operate in isolation because irrespective of what's happening, there's economists would argue it's intrinsically connected, but there is always an undertow of inflation supporting the growth in property, and your cash rate will influence maybe the speed at which the market system growth versus inflation-orientated growth. And hence the reason why we have a capital gains tax discount currently factored in the tax regime is they're saying, well, part of the growth in real estate assets is because of inflation.
That is a big part of the growth.
But it never really gets really spoken about too much. Everyone's always like, we've identified this because of all these fundamentals. There's a really good friend of fundamentals, and it's called inflation.
Inflation. See, when you're investing in property, you want inflation to be high. Because that actually increases your price. That increases your value because everything costs more. So building a new house costs more, and therefore naturally, the older, more established homes will also rise in value. So inflation is a double-edged sword as far as investing is concerned. As inflation increases, your interest rates do increase. Your cost of ancillary services, insurances, council rates, water, all of those things increase as well. But just as importantly, your base price, which is the value of your property, does increase as well. So on one side, you're bleeding money. On the other side, you're actually gaining equity.
Yeah, and this is the criticism of changes to the tax regime, and I haven't seen the numbers, but, and maybe in some markets a lot more, inflation-led growth versus market or system-based growth is 50% a fair number, pretty much going, well, you should get that discount because everything is grown at that time. So like for like, horses for courses, you probably shouldn't be paying tax on the bit that is just because it's there rather than something else, right? And this is the big question, or 33% or however it sort of plays out to be. So, how that lands, I don't know. But you spoke about what you're seeing on the ground right now, and I want to pick that up. And I didn't see the NAB info coming out. I'll go and associate myself with that. But I'd like to know how much of the 700 million or whatever that they're provisioning for this stuff is going to be the 95% deposit scheme.
I think that's a major part of it.
No one wants to. No, like it's a thing that no one wants to talk about because everyone spoke about it. Everyone, me particularly, at the start of it, going, "This is how this is going to play out." Right? You get 2 or 3 more interest rate rises. There's a lot of negative equity there.
Sure.
So maybe investors picking up stock of distressed first home buyers, unfortunately, is going to happen, right? But you mentioned you're starting to see some foreclosures coming through.
We are.
First home buyers or just?
No, it's just established properties, more your generational properties in the sense that they've been held in the family and people have bought it. But back step one, most of the properties that are coming now as mortgage in possession are a victim of the 2% interest rates.
Okay.
So people have gone in bought properties. Now they're in the high interest rate. They haven't done that.
This is mortgage cliff stuff. Actually,
yes, it's actually panning out now. And this is just feedback from the agents that I'm dealing with across Australia. Is that they're all saying that in the previous years it used to take 3 months for these mortgage in possessions to come online. It's now taking a year because the bank's working with them to try and help them hold on to the property.
Banks don't like it. Right?
No, they don't.
It looks bad. It looks bad in their annual reports when there's foreclosures, right?
Yes.
This is hardship teams inside of banks. This is one of the misnomers. A lot of people think banks want to, foreclose on people. The last thing banks want is to kick people out of their houses.
Absolutely.
They do lose dough.
Well, let's address the 700 mil. I hope I've got that number right.
It doesn't sound like a lot, to be honest.
It doesn't sound like a lot, right? But why would the bank quarantine that money or make provisions for that money? Because the banks are also borrowing that money, right? So if I'm the borrower from NAB, right, and I owe money to NAB and I stop paying, their cash flow gets impacted, but they still need to make the repayments to the money they've borrowed to lend on to you. Right. So that's what they need to then cater for. So they're addressing their cash flow problem ahead of time.
But let's dig into this a little bit more. For them to start provisioning or putting money away for this, mostly assuming that most of the loans that they have been bought at 20%. So they're therefore assuming price drops. On that basis, the LMI mortgage providers will cover the bid up to 80, right? But if they think they're going to be sort of selling stuff less than 80% of value or sold at, that's
debatable.
That's interesting
because I think the play they're making is more in the home owner market rather than investor market. So
Yeah.
it comes back to your comment of those 2% deposits and the 95% and whatnot.
Yeah.
That's where I think they are getting a bit more concerned.
The
with
Australian government
rising
picks
to-
up the tab on that.
Absolutely, they do.
Well, the Australian taxpayer, me and you
Yes.
do.
Yep.
We do. You know.
So how there's this rhetoric of all the taxpayers subsidize the investors. It's the other way around. We're subsidizing the homeowners.
Yeah, we're underpinning. They're underpinning their home ownership journey, and look, fine. I just think that they went a bit crazy with the schema system. But what you're seeing over the week and the weekends is a clear indicator of what it's going to look like in 2 to 3 months' time. And Reshmi, you must see with your the work that you're doing, sort of this ground truth. Is there any sort of real themes or trends you're seeing developing right now, which are sort of shaping some decision making?
I think people are holding back, and when actually it's two things. Some people are holding back. Some people are ready to go and do something because especially the clients we already have. People are coming out and saying, "I need to buy something now. I'm ready to buy." Because if I go back one more, it's what we've been teaching all along. And over the years, we've kind of managed this system that what they need to do in order to be successful. So people over the years have kind of seen the patterns, known what they've got to do, and got actually 2 people approach just in the last 2 days to, I need to buy again. I'm ready to buy again. So, it's,
These are the established clients, right?
Yep.
So they've gone through the ups and downs of property investing, and they're seeing that there could be opportunities around. And they're also understanding that this will dampen itself out. So get into the market while you can.
So what are you seeing actually playing out on the ground? So a couple more sort of mortgage possessions. Is it still a relatively normal market? You see, maybe not as many people attending open homes or people actually turning up for auction. No, auctions have been a bit sort of lackluster. A lot of auctions have been pulled prior to, or they're selling prior because they know the tension's not going to be there. Expect to see more of this over the next period, Victor?
I do think so. On the ground, we are seeing that there are less people physically inspecting. But just as importantly, there are quite a few people that are just making offers sight unseen on properties, where they are rushing in to get into the market, and they don't care what they buy. They're just wanting to buy something, which is dangerous in itself.
Are they represented by buyers agents?
Some are, some aren't. And this is where slow and steady wins the race at the end of the day, right? So you don't want to be rushed into an asset allocation just because there's potential or imminent legislation change. You just want to be making sure that you're just dealing with cash in, cash out, and looking towards the end goal that you have. Now, the other change I'm seeing in the market is that the agents are starting to call us back.
Surprise,
which is very interesting, right? It goes around a cycle, right? So you've got several cycles working over here. You've got the news cycle. The news cycle is in a little bit of a tailspin at the moment. So there's more doom and gloom in there. Then you've got your investor cycle, where there's more investors coming down into an area, and then certainly you've got your normal cycle, right? The price cycle, the lending cycle. All of those things are starting to come together, where the picture isn't as clear as it normally is, because everyone's talking a slightly different tune at the moment, because no one's 100% sure as to what's going to happen on the 12th of May. And everyone's talking, hedging their bets either way. But we do know that there's going to be change happening. There's enough rhetoric, there's enough leaks, there's enough pointed announcements by the government to say that there is change coming. We just don't know what it looks like.
And it's good to be prepared for it, but or you could say, well, irrespective, keep doing what you're doing right now. And I know people who sort of have a foot in both camps.
So one of the analogies I use, right, is that, you're going to put a pause, or you're going to stop investing because capital gains tax changed or negative gearing changed. And so if the bank, or if the government changed the PAYG taxation rules and increased your tax rate by 5%, 10%, would you stop working?
Yeah.
Yeah. The answer is no, right? Because you're working towards a purpose, you're working towards getting cash flow in. And so property is no different. Investing is no different. You are working towards a means. And if the game's rules change, you just got to adjust your play.
Yeah. It's really the market and the different aspects of it I find absolutely intriguing. And you've got on one hand discussions around sort of, messing around with capital gains tax and changing it up, maybe increasing it for some and decreasing it for others, and new properties versus existing property. I won't go too much into musing about what that might look like. But you've also got on the other hand discussions around around negative gearing and saying maybe limiting it to 2 properties. Well, most Australian investors have 2 properties, right? 97% have 2 properties. So you got to really sit here and put it into perspective, right? And often you fall into the trap because you're surrounded by people who invest in property and have typically more than 2 properties. You talk about it on podcasts. The cohort of people who maybe some of this is being connected to is in the tens of thousands, not the hundreds of thousands, right? And for those people that invest in and around trust-based structures, I like to see what you do there, because you don't necessarily negative gear inside a company or a trust structure, right? It's viewed as income in, expenses out. Is there a profit? Is there isn't a profit? Does it get distributed? Where does it get distributed to? That's when you might pay tax on it, right? So the application of negative gearing is directly connected to people buying in their individual names, largely PAYG type incomes, and or if they're SME business owners, that pay themselves a certain amount of income, right? Like that's where it gets really, really intriguing into the impact of any changes really on the market, how it's going to shape property prices. And there's always, a way people will maneuver around any changes in order to get the same connection up. You may get more people directing go into self-managed super as a result of this, which is probably the absolute opposite than your large super, your industry and retail funds want, because the taxation regime inside your super for property is going to be very different. Right?
It will be very different, yes.
There's always ways, there's second and third order impacts of this, but this is the noise that everyone is stuck with right now.
That's right. And so this is when news of negative gearing and all that rears its head up, and it rears its head up many times, right? So if you look at our properties, right, that within 5 to 7 years, they've become cash neutral to cash positive. Right?
That's what property does if you don't refinance them all the time.
So the reality of it is that majority of the property investors are actually paying more tax after they've gone through one cycle. Yes, the front end is helped by claiming the losses that you have to get to that point where it's self-sufficient or it is positive. So if this came in as a hard and fast change and people weren't prepared to spend the extra money to hold onto the property, all it'll do is slow down their investing cycle, right? Which would mean that there are less investors in the market, which would mean that there'll be less properties to rent out, which would mean that we haven't solved the housing crisis.
No, and I think a lot of yields over this last period of time, maybe because of the noise coming out of social media, is the forgotten component, Reshmi, of property investment. People rarely really talk about yields, and particularly sort of net yields, right, which are pretty bad when it comes to property. It's all been a capital growth play. So do you think yield, if there is seismic shifts to the tax regime, which it looks like there will be, and it therefore slows down the appetite for investing in property, yield's going to become the name of the game. It's really going to start shaping probably decision making around what to invest in.
It would, but then again, it comes back to the individuals themselves. Yield is one thing. If you want to, the whole focus is to get to an end result where your portfolio is going to work for you. So if you're only going to focus on yield, the choice of properties may not exactly be as a whole portfolio to get you to that result. If you're just focusing on the yields, you need, as Victor said, the port system that we talk about, and the different types of properties within it to so that overall holding cost is much less because one negates the other, or however we place it. So a yield on one of the properties may have a high yield when the other may not, may be costing you to hold.
Yeah.
So you have to balance that out. So if you're just focusing on the yield, you won't get that balanced portfolio, which will get you that result in the end that you're trying to get. So the whole idea is we're not only buying property or investing in property. Everybody talks about buying and investing in property, but we have to look at the out of it. Once you've gotten out, we have got many clients who have exited after investing and gotten out of it and let's say retired or choosing to do whatever they want to do. It's because of that set plan, and it wasn't only just the yield. And so the same applies no matter what cycle is. You've got to be finding a mix of the types of properties so that you can have the focus is that actual portfolio, not just a property and one property with a yield, and you buy 5-6 properties with the high yield, and what happens when things turn, then you're not having that successful portfolio there.
Yeah, the yields can be eroded very quickly with what happens in the market. You mentioned the pod, and this is the ideal time to actually look at setting up something that's passes the test of time. It passes the test of crisis. Ultimately, when you're investing, the front half of it is all about wealth creation, right? So this is, how much your portfolio value is within your means, right? So still able to hold on to that value. But then it needs to be pivoted so that it is then lifestyle, right? So how do we unencumber the portfolio, or how do we rationalize the portfolio so that we can start getting to the income side of it? Front end growth, back end is more a lifestyle, therefore income. And that gets you to your retirement. It's not how many properties, how much equity you've got behind you that gets into retirement, because you can't take a brick out of your home and take to Woolies to buy your cornflakes.
Not yet, fractional property. Where are you seeing the most friction in the market right now? And people always talk about opportunities. I think moving forward, assuming there's changes in the tax regime and considering some of the other incentives in the market, I think you'll get two-speed market. We would. You'll get maybe areas where there's greater demand, and there seems to be this collision of first-home buyers and property investors. They're buying the same properties. And then you may have owner-occupiers and more sophisticated investors at the higher ends. But I hear in Brisbane, for example, I think the cap on the 95% borrowing there is like $1 million that everyone just bids up to, and they've got these schemes now, or these software where you put your offer in, it's all done digitally, and then everyone's up to 995, 996, 996, 100, 996, whatever, and as soon as it hits $1 million, it just stops. It just stops. That's pretty when the investor picks it up at $1.00001 because it's sort of out of the realm of So this friction point, but that's got to be artificially inflating prices.
It is. So every time there's a government incentive in place, it inflates the market, right? So ultimately, when you really look at it from an economic point of view, the government won't fix house pricing in the sense that they don't want it to become cheaper, right? The reason being that when prices increase, people have that wealth effect, and so they're spending more, and therefore there's more money flowing through. In terms of all the soft costs, stamp duties, your if you're building a home, your infrastructure charge and all that fills in the tax system. So now it's if we actually solved the housing crisis and properties were on par with demand, we'll get into a stagflation or we'll go deflation. Yeah. So we want inflation. And I know this is controversial, right? In the sense that we, as voters, we want the government to fix the problem. But it is not a problem to fix. If you want wealth, you want inflation, and therefore property prices need to go up.
It's one of the great ironies of Australia, and I've shared similar logic beforehand.
Yeah.
The property economy. What we need is resilience in real estate, right? But the property economy is critical infrastructure to the health and integrity of Australia. This idea of, we need to make housing more affordable. Well, what does actually affordable mean?
No, I think the rhetoric is wrong. We need to make housing more available, not affordable.
That's the point.
Yeah. I'm running for parliament, by the way.
Yeah, by the way, the Victor Kumar property party. But it needs to be more available because an available will intrinsically have a relationship with affordability.
Yes.
But to say that we need to make housing's too expensive, we need to make it more affordable. Like there's 70% of Australians who have exposure to real estate, real estate assets, don't want the value of their real estate to go down.
No.
Yeah.
No one. And I'll tell you what, there's a generation of people waiting for their parents to cark it, baby boomers who are waiting to get the upside value of the value of that real estate. You think they would be happy?
Yep.
And they go, well, the estate's not worth that much anymore. It's worth this much because property's like,
Imagine that.
It's just,
Imagine that.
But be careful what you wish for. But to your point, the government doesn't want that. It doesn't want to stifle property investment because if the value of properties come down, guess what happens? That means there's a whole bunch of mortgages, to your point around NAB, connected with maybe a negative equity, right? Well, that's going to decrease the value of our banks. What happens if you decrease the value of our banks? Everyone's superannuation goes down because everyone's invested in it via their superannuation funds. The government still needs its lick. It needs its, it needs transactions to take place at a state level. And it needs investors at a state level paying land tax.
That's it.
It's the great irony. On one side you say, hey, we've got to make it more affordable, but in the background it's like,
just play around, just make them happy.
Mess around.
So if you look at it historically, right, so every time there's been crises where value potentially would go down, the government's always stepped in with incentives. GFC, it was the pink pads. If you look at COVID, they pumped in money into the economy and that shored up the price and they dropped the rates down, right? So that shored up prices. So rather than going to a free fall, it stabilized and in fact increased the value of everything.
Yeah. I was doing my land tax stuff recently and the arbitrary way that a lot of these state governments work out the value of your I just went, how did that go up by 40% a year?
Yep. Don't put me on my soapbox.
How do you raise taxes? You go, well, that property there, that bit of land's not worth $200,000 anymore. It's worth $300,000.
Yeah.
Well, how'd that happen?
Yeah.
It just happened. What's the consequence of it? More land tax. What happens? That land tax goes into state government's coffers, gets spent on infrastructure projects.
That's it.
That's
it. Yeah.
You can be a cynic with this stuff, and it's probably too big for any one person to understand. I don't think there's one person in the center of things like was a Wizard of Oz sitting behind the green curtain, sort of, framing this thing. Maybe there is. Maybe
so this is where it turns from black and white into color, right?
Yeah,
so,
probably.
Have you got numbers on the number of investors and their expenditure on normal living expenses? And the majority of the population is not investing in their expenditure. So where does that sit? Now, isn't that a huge expense? The population who's spending more money, and where's the inflation coming from? Couldn't that be something to look at?
So you're saying it's not the property investors, it's people that don't invest in property that have more disposable income, and therefore they're spending more money and therefore driving up prices, which is helping property investors because a lot of
prices
the increase of their fees.
Yes, it's a vicious circle, right?
This is why these sort of, colander spaghetti hat people sort of sitting there smoking their bongs on a Saturday afternoon talking about how the man's running the things. Like these are the type of things they sort of come up with, right? These sort of, what do you call them? These schemes or these, conspiracy theories around like, how everything's being manipulated by the man.
I reckon, there should be a push to get politicians, get authorities to say things the way they really are. So it's like we need to get prices up because it helps with the country, helps with everything, right?
Yeah.
Rather than, we're in a housing crisis supply crisis, because we look at right back to 1920, and from there, we've always had a housing crisis.
We always have done.
Yeah.
I saw Tom Panos putting some stuff up over the weekend, pretty much talking about the crisis of headlines, which are pretty much going to mirror the headlines that we're going to have past May, which is pretty much going to be saying the same things they're saying in the 1920s, how unaffordable housing is. Housing is unaffordable, housing unaffordable, housing unaffordable. So
So this is where people, they start playing a very defensive game, right? I'm going to
it's the point, should you be playing an offensive game now versus a defensive game?
It's widely known. I play a lot of soccer, right? So I'm going to bring in an analogy, right? So when you're winning, the natural tendency is to fall back and defend. So if you've got a few properties, if you've got a few wins, you naturally stop buying, you stop working on your portfolio, you just don't do anything, right? Just keep the lead in there. So often when that happens, that's when you fall back and you stop playing aggressively.
It sounds like me at the moment.
So then you concede a goal because mistakes will happen, you get tired of defense, right? Whereas the other side of the coin is that if we're against a stronger team, naturally we started try and fortify our defense a lot more, and then we say, we'll just have one forward, and then everyone play defense to stop the goals from happening. But until you are actually pushing ahead, that's when you actually get to the goal, right? And so when you look at property in itself, yes, there has to be defense, right? The fundamental defense. So get your insurances in place, make sure your mortgages are up to speed. So if you have excess of equity, you want to draw down the equity right now and park it in an offset account. Then you also look at within your portfolio to say, okay, there may be a cash flow issue down the track. So interest rates would go up. We don't know what the negative gearing is going to do. And I want to bring forward a construction of a granny flat or secondary dwelling because it makes sense because the cost of constructions continue going up. I'm going to bring in this cash flow forward so that I have that cash flow before I need it, right? So we are playing defensive by being offensive, And then we also look at the actual plan. What are we trying to achieve? Do I need to adjust it to push the goal out 2 years, or do I need to bring it forward a couple of years in line with what's happening in terms of interest rate, in line with what's happening in terms of the industry with so many buyers agents out there, so many investors out there, in line with interest rate rises, in line with everything. So this is where we need to play a dare I say an offensive defensive game.
I think it's a really good analogy, and it can really play with your mindset and how you frame this. But this old adage of the best defensive offense is offense is what you're saying there. And if you adapt a defensive posture, using soccer as an analogy for it, you don't think as aggressively.
No.
And when you're thinking less aggressively, you're worried about maybe getting hurt. You maybe you're worrying about all these different things. The holes start appearing, and that can be exploited, right? And that is this sort of defensive mindset. So it's nice to have a comfortable relationship of being both simultaneously. But what you want is structural defense, but you would need an offensive mindset.
Correct.
Is how I would probably frame it.
Yep. That's right. Looks like you need to run for parliament.
Maybe. Be surprised how many people have said that. Would you want to do it, right? Like it's back to the point. It's a mug's game trying to work out the property economy. Like I've done all these pollies sort of, well, the bureaucrats sort of behind the scenes. Who are some very bright people in our public service, like trying to work all this out. Like, good luck, no matter what you do.
Too many variables.
What you do, and one of the challenges we have, and if 70% of Australians, these are base numbers, right? But assuming 30% of Australians rent, right? That means everyone else, working Australians, either own a home with no debt on it, or they own a home with debt on it, or they're probably investing in property in some capacity, right? So how do you govern for the masses while ensuring a fair and level playing field for everyone here today and tomorrow? One of the challenges we have, I think, is that certain cohorts of the community are overrepresented in terms of the voice that they have in terms of shaping that discussion. And we live in a democratic environment, so the masses should really determine how things do. But you look at some of the highly funded by government, and I would say sometimes militant rental bodies that represent the people who rent. It's over, particularly at a state government level. Geez, there's some overrepresentation.
There is.
There's so much overrepresentation, and that is part of this whole idea that's stifling maybe the attractiveness of investing right now, because you've got this constant market manipulation over here on one side, governing and ruling how these things take place. It's this is the noise that you get stuck in your head, which forces you to sort of move to a defensive setting.
Yep,
you know,
you're right.
unfortunately.
Right. Yeah, and this is where you need to understand that is it governance through fundamentals or is it governance through headlines?
Yeah. And it's a bit of both, I think. But anyway, when's the next Right on Track?
Oh,
Reshmi?
in another 3 months' time.
Yeah.
Yeah.
We can do a post-election Right on Track. Maybe.
Maybe just before the financial year.
We just decided to do it quarterly now because
okay.
once
Too much.
once a month.
Every fortnight.
Every fortnight,
Used to be
every other
fortnight, yeah.
Tuesday.
Yes, that's right. Yeah. We'd, they constantly have 100, 150 people in there. Yeah. So,
but it was really nice to see the results of people who have come and brought people along. They just believe in so much of the results they've gotten, and to bring others along was really nice.
Who's your most still active oldest client? Would you know who that is? You don't have to give me your name, but would you know who it is?
We were just talking about really old clients who have now
you're
retired.
doing like grandparents. You're doing grandkids now.
Grandkids now.
Yes.
Yes, grandkids. Yeah. So that there would be quite a few handfuls of clients that have gone through helping their kids and now helping their grandkids. It's
crazy.
Yeah. The oldest person I've ever helped invest.
Are you going to name or just
no.
Okay.
was 70 years old, and we got her home through some very clever structuring and very clever navigating of the rules to be able to get her
pensions
into
and stuff.
Yes, to get her into a home. This was her first home she's ever bought, and she still writes to me.
Really? She happy?
She's very happy.
How long ago was this one?
This was 10 years ago.
Wow.
12 years ago.
Did she
even.
plant a tree and call it you or something or other? Like
I
a jacaranda tree
don't know.
called Victor?
I hope that I'm in the will.
You got to be bequeathed properties.
Yes,
That's
it.
Oh,
That's it.
Wow.
Jesus, that's right. So, but on the basis, if people want to have a yarn here, what's the best way to track you guys down and sort of get stuck in?
Yeah, just jump on the website. Just hit your contact me button, and it'll get you in touch with us.
Yep.
There is a bit of a process. Obviously, you just don't get to start talking strategy. So there's a preamble to it. We do get a lot of information off you to make sure that then we're giving you the best guidance possible.
Fair enough.
Yeah.
Makes sense. Well, thanks, gang.
Absolutely.
Good to see you. Next time we get together, we'll be post-budget.
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 Ooh, that'd be fun. That'll be fun. That's good. Well, rightpropertygroup.com.au is the right website. Great to see you both. Are we sort of, when's the end of our special series on Design Your Decade?
We're getting towards the end of Design a Decade, and then we'll come back and backfill all of the gaps that we've created in that process, so that people can look at it as a system and implement it with or without our help.
Yeah, nice one. Well, thanks for joining us. This is Property Investing Insights with the Right Property Group, Victor and Reshmi Kumar. Hope you enjoyed. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature, does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you.